Bitcoin has underperformed my expectations in this particular cycle. I started out with conservative expectations, which was I thought the 2021 cycle, I thought we'd get to $1 trillion market cap. We did. Once we got there, I was like, yeah, I could see us hitting 100K this cycle. And we did, and we only got to like 69K. So my kind of revised bullish take wasn't quite met. Even my first one was. Then we go into the bear market. Then I basically said, I'm not really going to try to make a price target this cycle, but when pushed, I would say anything under 150K is kind of disappointing. And we only got to 126. So I would say it is kind of a second, kind of a lackluster cycle. I think treasury companies took some of the euphoria out of it. Yeah, I think that overall this was a somewhat disappointing cycle. It doesn't change my long-term thesis about it. So I think these things take time to catch on. So every cycle, I think you probably would get more of them. But I wouldn't bet the farm on like any one giant one saving a whole cycle. So I think it pays to be kind of prudent.
The global financial system is unraveling in real time, and the signs are everywhere. Central banks are scrambling, governments are clashing over trade, and the dollar's role as the world's reserve currency is being questioned like never before. Gold just experienced trillion-dollar swings in hours. Bitcoin's 4-year cycle might be broken, and the Fed chairman went on camera to accuse the president of trying to destroy the central bank's independence. This is not normal market noise. This is the sound of a system reaching its breaking point. For years, warnings about debt levels and money printing were dismissed as paranoia from the fringes. But now, those warnings are mainstream. Major institutions are diversifying away from U.S. treasuries. Precious metals are soaring, and the playbook from the 1930s and 1940s is being dusted off, as we live through a mirror image of those eras. The fourth turning has arrived, bringing sovereign debt crises, trade wars, institutional collapse, and a complete reshaping of how money works. Now, Lyn Alden, in her latest analysis, cuts through the chaos with brutal clarity. She explains why Fed independence is dying, why the gradual print has replaced quantitative tightening, and why Bitcoin's disappointment this cycle might actually be setting up something far bigger. This is not about quick wins. This is about survival in a monetary order that is coming apart at the seams. Let's hear directly from Lyn Alden for more insights. Please don't forget to like, subscribe, and enable notifications. Thanks for tuning in. Enjoy the rest of the video.
I think we are basically in the fourth turning, which I'm not the first person to say that, but the way I break that a little differently, because I look at things a little bit more quantitatively, which is to say we're on the rough side of the long-term debt cycle. And with a long-term debt cycle tends to come other things along with it, which is why I always feel like everything's happening all at once. So sovereign debt crises tend to lead to more war, and war also can lead to sovereign debt crises. So these things kind of feed off each other. It also tends to lead to, like, you have decades of debt building up, and then you usually have decades of like lulls building up and kind of like this entropy in the system. And there's usually some sort of clearing event that happens, which can be a pretty dangerous or challenging time, because it's kind of like the shields are down for all the norms that people are used to. In Trump's first term, toward the later part of his term, Powell and the Fed were raising rates. Trump was not thrilled about that. They started to cut them in late 2019 when we had more recessionary indicators, even before everything that happened in 2020. They obviously were super dovish in 2020 and 2021. It's kind of another moment where they all agreed on what they're, in hindsight, there's pain from it, but at the time, there's really no disagreement at the moment. But as we got into 2022, it was kind of like that moment in say the 40s where like the war is over and the Fed's like, okay, so like we're gonna get a little more hawkish now, and then the executive branch says, well, not yet. So we had the Fed try, they said, okay, we totally misjudged inflation. I mean, they did not expect inflation to occur. They had forecasts for low rates when inflation did occur, which many of us were kind of pointing out that it very much likely was going to occur. But they started to then, rapidly turn more hawkish. And this was during the Biden administration, but then they kept it up in the Trump administration. Trump's been very outspoken about wanting more dovish policy. And I think there's also, whenever you have a period of higher uncertainty about what policy should be, I mean, this is like, central bank rates are literally price controls on like the price and time of money. So they're in some ways the most important price controls around. Most people, if you say, should this thing have price controls on it? Most people would say no, but that's how central banking works. You have price controls on money and time. And so you have, on one hand, you have still above target inflation, but it's mostly outside of the Fed's wheelhouse because it's not excessive bank lending that's causing the inflation. It's more fiscal deficits that have been causing it in this cycle. Interest rate policy and balance sheet policy could be quite separate. So you could have them be quite dovish on interest rates and say, we're going to cut by 150 basis points rapidly, for example. But then they also might say, we're not going to increase our balance sheet for the next 6 months. And we're going to try these other regulations to, let banks hold more treasuries, for example. And then interest rates, there are some environments where interest rates are the bottleneck and that they are what is, say, holding back bank lending, which would contribute to broad money supply growth. And there are times where they're not the bottleneck. And so you can have a situation where you cut interest rates and it's not that impactful because they weren't the bottleneck. So that you cut short-term interest rates and maybe long-end rates just stay flattish. There's in their range up and down depending on, macro conditions, not really trending in any direction. And you can cut interest rates by a decent amount and the house financing doesn't really get any easier. And so that more affects, currency differentials. It can have an effect on more shorter term, kind of business borrowing, which is relevant. It's just not massive. And so I would generally think that whoever he picks is going to be pretty dovish on rates. I think that's been pretty much set in stone. Balance sheet's a little bit more of a question, but I generally think balance sheet is kind of gradually up and to the right. And I think that the combination of rates and balance sheet will keep the broad money supply kind of gradually up and to the right for the next couple of years. I've been in the camp that as I see this world get more multipolar, it's hard to know the time frames that these things happen on, which is, it's funny because some Bitcoin proponents really don't like gold. Some gold proponents really don't like Bitcoin. I've been in the camp that likes and is long both. So that
is an option, by the way.
Yeah,
you could be bullish on more than one thing.
Yeah, it's been an option. I've been long precious metals longer than Bitcoin. Because initially my thesis, okay, this is all happening. I'm going to go own gold, and then as I learn more, I'm like, well, okay, I'm going to add Bitcoin to this thesis too, because it's many ways better. So it has, it's been out. Bitcoin's outperformed during that time, even though it's underperformed more recently. And to answer the other question, I have been, Bitcoin has underperformed my expectations in this particular cycle. I started out with conservative expectations, which was I thought the 2021 cycle, I thought we'd get to $1 trillion market cap. We did. Once we got there, I was like, yeah, I could see us hitting 100K this cycle. And we did, and we only got to like 69K. So my kind of revised bullish take wasn't quite met. Even my first one was. Then we go into the bear market. Then I basically said, I'm not really going to try to make a price target this cycle, but when pushed, I would say anything under 150K is kind of disappointing. And we only got to 126. So I would say it is kind of a second, kind of a lackluster cycle. I think treasury companies took some of the euphoria out of it. So some of the money that might otherwise have gone into, say, just cold storage Bitcoin goes into, leveraged shares of these treasury companies that are trading at X times, MNAV. Which takes some of the price action out. So I think maybe without those, you could have gotten a little higher. But then also they were also partially fueling the buying of it to some degree, especially MicroStrategy. So yeah, I think that overall this was a somewhat disappointing cycle. It doesn't change my long-term thesis about it. That basically a decentralized ledger is still very valuable. It's the only way to do that we know of to do permissionless payments and portable secure savings. And then the second part of the thesis is, that these things have network effects. So you pick one that you view as decentralized, secure, and is likely to win basically the liquidity war, the network effect war. Obviously, we had disagreements around, say, Bitcoin versus Ethereum and others. I've been in the Bitcoin camp, which is, okay, so a decentralized ledger is valuable. That's the largest, most liquid one. It's kind of the one that's kind of geared towards simplicity and kind of, maximal decentralization. And so the thesis is that would continue holding up, and also has bullish on stablecoins along the way as well, even though they run on largely other rails. And I would say in this cycle, Bitcoin is still, dominant cryptocurrency. So 17 years in, I think that part of the thesis continues to hold up well. People have their their views on quantum and other factors that contribute over the next 5, 10, 15 years. But so far, I'd say that part of the thesis is on track. And the part that's going slower than expected is just the demand for any decentralized ledger, which is, I still think it's valuable. But I do think the world's kind of maybe a little slower to recognize its use.
Lyn Alden does not sugarcoat the situation. She believes we are on the rough side of a long-term debt cycle, and this is why everything feels like it is happening at once. Sovereign debt problems lead to war. War leads to more debt, and both destroy trust in the institutions that were supposed to hold everything together. She points out that many of the systems we rely on were built generations ago and are no longer suited for the world we live in. Demographics are collapsing, social media spreads chaos faster than any government can control, and the tools central banks once used to manage crises are now exhausted. When Alden talks about the fourth turning, she says we are in the same phase as the 1930s and 1940s, when debt levels exploded, interest rates were pinned to the floor, and central banks lost their independence to treasury departments. The Fed was captured back then, forced to print money to fund the war effort while inflation raged. Today, the Fed is not yet fully captured, but the pressure is mounting. Trump openly demands lower rates, and Jerome Powell is publicly fighting back, something that has not happened since 1951. That was the year the Fed and Treasury signed an accord to restore separation after years of control. Alden says we are headed back to that same fight. Now let's listen again to Lyn Alden for more insights and analysis.
Yeah, the way I look at it is that so in the early stages, obviously the 4-year cycle was impactful because the new supply was so large and meaningful that a half reduction in that new supply really affected market dynamics and could be a catalyst for the next bull market until that euphoria gets overdone. Now, as the new supply has gotten so small relative to other factors like the rate of OG selling or not selling, the rate of big new buyers coming in, these are all much bigger factors than the new supply that comes from Bitcoin in a halving. And so fundamentally, I don't think there's any reason to have the 4-year cycle expectation in play. I do think that behavior tends to change with a lag from fundamentals. So even though the 4-year cycle, I don't think it mattered fundamentally this cycle, and I think last cycle still probably wasn't the biggest factor, but was a little bit more of a factor than this time. I think it takes a couple cycles for the psychology to catch up, and so I do think that there was some self-fulfilling prophecy, which is that people say, well, if Bitcoin's only going to get this far this cycle, and then I'm risking a 2-year bear market, might as well get out now and see if I can buy back later. And if enough people think that, then you get that happen. And then, of course, when it's down versus expectations, you have some people panic sell or get liquidated if they were leveraged. So then it feeds on itself, and you clean out pretty much anyone who owned it for the wrong reasons or that owned it on too much leverage. The one part that I have been careful of is it was about this time last year, I would get on podcasts all the time, and people say, well, what do you think about the sovereign Bitcoin reserve? And that's the part I would kind of push back on and say, any of my models are not going to include it, because I'd rather be surprised to the upside than surprised to the downside. My default view was, okay, they're probably going to ring fence the Bitcoin they already have, which they've largely done. But that I wouldn't bet the farm that they're going to go out and buy 500,000 coins, regardless of what some of the proposals were, just because the status quo for governments is no change. Now, obviously, in a Trump administration, that there's more variables. We just talked about how just rapid things can be. So if you ask me, would the tariff war have gotten this elevated a year ago, I probably would have said it wouldn't be my base case, right? So that hit kind of the unusual levels, but the sovereign Bitcoin reserve didn't. So I think it is right to be cautious on expecting one big pool of money to come in and save a cycle. It's nice if it happens to the upside if you're long, but I wouldn't bet on that. Instead, I think you want to have conservative expectations and be more, just like prudent with expectations. I think that we've generally seen, so obviously there's career risk, right? So if you're a central banker and you buy Bitcoin and the Bitcoin goes down, you probably lost your job. Same thing if you're a corporation. So generally speaking, the ones that do it are ones that operate like an individual or a small company. It's because some owner, like some CEO is like either the founder or a major shareholder, unlike most corporations where the ownership is pretty diffused. So someone like a Saylor, someone like a Bukele, that they have kind of a higher than normal level of control of the entity that they're overseeing, and that they can make maybe not fully unilateral decision, but closer to unilateral decision to do something the way that a small business or an individual might operate. It only takes you and your spouse to make a decision. And I think that that's kind of the cycle we're in. Now, no one followed strategy really in that first cycle they did it. Now, obviously, we've had more imitators this cycle, for better or worse. So I think these things take time to catch on. So every cycle, I think you probably would get more of them. But I wouldn't bet the farm on like any one giant one saving a whole cycle. So I would separate strategy from most other treasury companies, and I probably would put Metaplanet in the more stable one too, which is that there are several of them that I am worried about. I mean, basically, I think they got way overdone, didn't structure themselves super well, expected the bull market to go on longer. Strategy, obviously, the share price taking a massive hit. If you look at their actual debt ratios, they're still pretty reasonable, even after the sell-off of their collateral. And I think one of the best decisions they made was they made that dollar reserve, perhaps somewhat ironically, but they have this dollar reserve that can cover currently approximately 2.5 years of their preferred dividend payments. And then their convertibles are a pretty small percentage of their asset base and are not due for a number of years either. So they've kind of structured themselves for a pretty big drawdown. And I've gone on 2 of their earnings calls as an analyst. The one was 6 months ago, and I asked about stress testing, like downside scenarios. You're right at the euphoria phase, and I was like, well, if everyone's going to ask bullish questions, I'm going to ask the bearish questions. Like, how are you thinking about stress testing this? So they basically said they were trying to gear toward 80 to 90% drawdowns and still be, solid. So we'll test that, but so far it's gone down pretty far, and they're still functioning. And I don't really see anything breaking them in the next few years, especially now that they have this kind of dollar reserve. Obviously, if you were to have like a 5-year plus bear market, if you fast forward to like early 2030s and we're sitting at like $40,000 per Bitcoin, they're probably massive trouble. Yep. But I don't see them any in sort of near-term trouble. But then I would separate that from like weaker ones that have just not structured themselves, that don't have the liquidity network effects of MicroStrategy, that maybe haven't termed themselves out with like long duration convertibles or preferreds, or they got over their skis in other ways.
Lyn Alden's outlook for Bitcoin is measured, not reckless. She admits this cycle has been disappointing. She expected at least $150,000, and we only reached $126,000 before collapsing. Corporate Bitcoin treasury companies took some of the market's euphoria out of the market, and the self-fulfilling prophecy of the 4-year cycle might have led to early selling. But she does not see this as a failure of the long-term thesis. Bitcoin is still the most decentralized, liquid, and secure digital currency in the world. The problem is that adoption takes longer than bulls expect, especially when people are not immediately hurt by not owning it. You can run out of oil and feel the pain instantly. You can ignore good money for decades. Alden also pushes back hard on the idea that sovereign governments will rush to buy Bitcoin. She was cautious about the strategic reserve a year ago, and her caution proved correct. The U.S. government has only ring-fenced the Bitcoin it already seized. It has not gone out and bought more. She warns against betting the farm on one big buyer swooping in to save the cycle. Instead, she expects slow, steady accumulation from individuals, small companies, and eventually, after many years, from governments that finally understand the value of a neutral, permissionless settlement layer. On the flip side, gold has exploded, and Alden is not surprised. Central banks, especially China, are diversifying away from treasuries and stacking gold as fast as they can. The trade war, the weaponization of the dollar, and the confiscation of Russian reserves have made it clear that holding only U.S. assets is risky. Gold is the obvious hedge, and Bitcoin is the next layer. She believes we are moving toward a multipolar world where no single currency can serve the entire globe without suffering from the Triffin dilemma. Instead, we will have multiple hubs, the US, China, maybe Europe, all bridged by neutral reserve assets like gold and eventually Bitcoin. Alden's advice is simple but disciplined. Own a mix of high-quality equities, especially outside the US, where valuations are cheaper. Own hard assets like gold, silver, and Bitcoin. Own energy infrastructure that AI cannot disrupt. Keep some cash for opportunities. She is not betting on a blow-off top or a sudden collapse. She expects gradual money printing, gradual inflation, and gradual erosion of trust in fiat currencies. Now, do you think Bitcoin can break free from the 4-year cycle, or is this pattern here to stay? Let's have your thoughts in the comments below. Thanks for watching. Don't forget to like and subscribe.